All right, everybody. Welcome back to Strongman Personal Finance. I'm your delicious host, Strongman, and today we're going to talk about exchange-traded funds, also known as ETFs, and why you should not buy them. Are you ready? Let's go. Before we get into the dirty details, I insist that you like and subscribe to my channel if you enjoy my content. I love making videos for you guys, but when I see dozens or hundreds of views and nobody subscribing to my channel, it really hurts my feelings. So please, if you like these videos, please like the video, please subscribe to my channel, and hit the bell button for notifications. I know it's hard, but you can do it. So what is an ETF? Basically, it's kind of like a mutual fund, and it's kind of like a stock. Now, with a stock, you can buy and sell a stock throughout the day, but you're only buying and selling one stock. With a mutual fund, you're actually purchasing shares of the mutual fund at the end of the day once the market is closed. The fund managers have to calculate the value of each share of the mutual fund. So when you place an order to purchase into the mutual fund to buy a couple shares of the mutual fund, they don't know the value of those shares until the end of the day. So stocks and mutual funds are completely different things. They have similarities, but when you can buy them and when you can sell them is a huge difference. Now, some financial geniuses thought, hey, we could combine the ability to purchase stocks throughout the day, the liquidity of the stocks, with mutual funds. So an ETF is just a mutual fund-like investment that trades throughout the day. Now, one major difference between an exchange-traded fund and a mutual fund is who you're buying the shares from. When you buy or sell shares of a mutual fund, you're buying and selling shares from the mutual fund itself. You place your buy order or your sell order, the fund managers take that order and they buy and sell securities on the market in order to fulfill your order. Now, when you buy or sell ETFs, you're actually buying and selling it from another person who owns the ETF. You're not redeeming those shares from the ETF itself. This is why ETFs are more tax efficient than mutual funds. Mutual funds have to pay taxes when they redeem shares for their shareholders because there are underlying investments in that mutual fund. So when some shareholder wants their shares redeemed, the mutual fund managers have to sell the underlying investments to generate the cash and liquidate those shares of the mutual fund. With an ETF, you're not going through the ETF managers themselves to liquidate the shares. You're selling those shares directly to another investor. That means the ETF itself is not incurring any taxable obligations. On top of that, most ETFs are going to have lower expense ratios than their mutual fund counterparts. And that's simply because most ETFs just track indices. They're not actively managed. Now, there's some actively managed ETFs that are starting to sprout up. But on average, the average ETF is going to be passively managed and it's going to track an index. Now, indexes are easy to track. All you have to do is buy the shares of stock that are in the index. There's no thought that goes into it. There's no research that needs to be done. The managers are basically just buying the shares of the index. That's why it's super cheap. Why would managers charge a ton of money to simply copy the shares of an index that they're buying? They wouldn't. That would be stupid. So on average, ETFs are going to have lower expense ratios than mutual funds. Now you may be thinking, wow, ETFs just sound amazing. They are more tax efficient. They usually have lower expense ratios, and I could buy and sell them throughout the day. Well, let me tell you what, that's really not a good deal. Why? Because you're going to be tempted to sell the shares of your ETF throughout the day whenever the market crashes. And let me tell you, that is not conducive to long-term investing. Now, the reason long-term investors are better suited in mutual funds is because you can't sell mutual funds throughout the day. You're not going to be tempted to sell the shares of your mutual fund as much as you would if you had an ETF. Think about it. If the market's crashing, you can actually take action right then and there to sell the shares of your ETF. With a mutual fund, you know you can't redeem those shares till at least the end of the day. So at least with mutual fund shares, you have time to sit back and think, do I really want to sell the shares of my mutual fund? With an ETF, you can freak out, you can jump on your brokerage account, and you can sell your ETF right then and there, probably at a huge loss. Now think about this. If you're a long-term investor, what is the purpose of being able to buy and sell ETF shares throughout the day? There is no reason. Let's say you have a 30-year time horizon. When you have such a long time horizon, daily or weekly or even yearly fluctuations of the market don't mean anything. You don't want to be tempted to sell based on fluctuations in the market in the short term. That's how you lose your freaking money. And with ETFs, they're going to tempt you to sell your shares when the market crashes in the short term. But the purpose of long-term investing is to hold those shares for a long time horizon. You freaking buy it, you freaking sell it 30 years down the road. That's the only reason you're doing it. If you try to sell anytime in the interim, you're really not long-term investing. You're speculating. ETFs will tempt you to speculate on the market. And let me tell you, the average investor sucks at timing the market. Go read the data. You don't have to trust me. You can Google it and read all about it. The average investor thinks they're super smart and they can beat the market. And guess what? They suck at beating the market. So yes, ETFs are more tax efficient. Yes, they may have lower expense ratios. Yes, you can invest in all different types of ETFs. There's tons of ETFs out there that invest in stupid, ridiculous fads like, I don't know, beach ball stocks. Just go look. There's thousands of ETFs out there that track some of the most ludicrous indexes you can possibly imagine. Now, you can invest in those and jump onto the newest fads and be tempted to buy and sell whenever the market crashes in the short term, or you can invest in index mutual funds that are pretty much the same price. You know, maybe they'll have slightly higher expense ratios, but not significantly higher. You could invest in those and have much less temptation to sell them when the market's crashing in the short term. Okay? So please, you may think ETFs are cool and it's the new millennial investment, but trust me, they're really not that great of a deal. Now, my one caveat to this whole video is if you can pledge to me that you will buy an ETF and you will never sell it until you actually need to sell it based on your target retirement horizon, then you can buy them. But if you think you're going to be tempted at all to sell those shares anytime in the interim, you don't want to buy them. You need to have supreme self-control to buy ETFs, which most people don't. Okay? So just trust me. You may pay 1 or 2 basis points more for an index mutual fund in expenses. But guess what? It's really not going to make that much of a difference. And it'll probably result in you having more money in retirement because you aren't tempted to sell your funds at the worst possible moment when the market is temporarily crashing. Okay? Thank you. Now, if you guys enjoyed this video, like I said previously, please like, please subscribe, please drop a comment in the comment section and hit the bell button for notifications. You guys have a wonderful, delicious day. Bye.